Industrial services and car retailer Imperial has reported a 40% rise in full-year headline earnings per share to 976 cents. This largely due to an increase in vehicle sales over the past 7 months as interest rates fell to their lowest level in at least a decade, spurring consumer spending. CNBC Africa's Godfrey Mutizwa spoke to Imperial CEO Hubert Brody and asked him how the company managed to achieve these results in the current environment.
Our results are due to a number of factors. On the one hand, last year we made a lot of cost cuts and cost savings. We streamlined our network significantly. So the hard work around costs was actually done in the previous financial year. We've now been able, as we got a little bit of volume increases coming through, we've been able to capitalize on that, and our margins improved significantly. We've had some assistance from the currency. The currency has been very stable. But then also the products which we distribute, particularly motor vehicles which we sell, were very popular this year, and we did gain significant market share.
Were there any particular brands that were particularly strong this year?
Yeah, the Korean brands were particularly strong this year.
Then they were able to gain market share against the established brands from Europe, from the US.
Yeah, and this is really the issue here, is that it's at the right price. It was the right products at the entry level in the market, where the demand really is greatest right now.
So we cannot really be talking about a turnaround in the motor vehicle sector, can we?
Look, for our financial year, the motor car market is only up 2%. But in the last 6 months, it certainly has picked up its head. We've had an improvement. But on a comparative basis, if you go back to the market that we had in 2006, we still are not even 2/3 of what the market was then. So yes, we're up from a low base, but still at quite subdued levels.
Yeah. Now, we've of course had the World Cup, and everybody has been talking about the impact of the World Cup on groups like yours. How much of a kick did you get out of the World Cup?
Look, the World Cup was good for us in a couple of fronts. We really enjoyed being the transport company that transported the 32 teams, and we were on time at every match with our vehicles and our coaches by which we transported them. What also was of assistance is the global sponsorship of the World Cup by Kia and Hyundai, and we benefited through that, through the presence of our products in the market and acceptance of the products. And then in the car rental business, our fleet was 20% higher in June than it is normally in June. So we certainly had a strong June and also July in car rental. So it has been of assistance. But if you look at the group as a whole, financially the World Cup was actually not a big thing, but it was a very exciting time, which was very fulfilling.
Now, many economists talk about the benefit of the World Cup, not so much as coming in the actual event itself, but in the big advert that it made for South Africa and for Southern Africa to the rest of the world as a stable region able to host a big tournament like the World Cup. How much of it are you beginning to see in the forward bookings and the forward planning stemming out of hosting the World Cup?
Certainly it was a great window for the world on South Africa, the World Cup, and we've had many of our clients that returned to their home countries very happy, and we might not have seen so much forward bookings yet for car rental and travel, but certainly a large number of inquiries having come in from particularly countries where we've previously had virtually no foreign tourists. From countries like Mexico, you had virtually no foreign tourists, and we've even had inquiries from shores like that.
Yeah. Now, in this half, in this segment of results, as you said, it was more the work that you did in the prior year that made the big difference. How much more is there to extract in terms of cost efficiencies in the business?
Look, we should always be vigilant from a cost point of view and make sure that we run our business as tightly as possible, that our capital management is as good as possible, that we never have wasted capital that's maybe not optimally used. But we're really now looking for top line growth, and I think there's still quite a bit of fuel in the tank if we get some more top line growth coming through, and if there's scale and numbers coming through this very streamlined cost base, it should be beneficial to us.
How much are you anticipating in terms of top line growth?
That's very difficult to put a number on. It's very much dependent on how the motor vehicle market performs in the year ahead. But if you look at the growth of the motor vehicle market last year, we should definitely have positive growth on that line.
Probably double digit?
We'll have to see.
It is possible. Okay. You are on record now about your strong balance sheet and about the possibility of acquisitions going forward. How big is that balance sheet, and how much is it able to generate in terms of the amount that you'll be able to use for acquisitions?
Yes, our gearing is quite low. It's at 39%, and that therefore gives us significant capacity to grow organically, to spend on capex, but also to make acquisitions. So should we want to, we have a couple of billion rands of capacity, but our style have always been to make bolt-on acquisitions, the smaller acquisitions which we can make and which can fit in relatively easily with our structures and with our current operations. But the Southern African market for logistics is important to us. Africa is important to us also from a logistics point of view. From there, the CIC acquisition, which we recently announced, which was a relatively large acquisition, 724 million. And then even in Europe, if the right opportunities come within our areas of focus there, we would acquire as well.
And in terms of the growth of your divisions in Southern Africa, are there any specific countries that you'd be targeting in those potential acquisitions, if I may say?
Yes, South Africa is always our most important area. We'll be well established in the SADC countries soon, particularly due to the acquisition of CIC. But we are always on the lookout for South African companies that have transport and logistics services going up into Africa. So it would not necessarily be a non-South African companies, but we would be looking for ones which are actually active north of the border. Maybe countries like Kenya and Tanzania, Malawi would be of interest.
You're not mentioning Zimbabwe, and yet Zimbabwe, everybody's talking about Zimbabwe potentially recovering and perhaps regaining some of its former economic strength.
We already have a very large transport and logistics business in Zimbabwe. It's a very successful business, and we last year, in the previous financial year, completely refleeted there, and we have about 200 trucks which are very active in Zimbabwe, so we operate successfully in Zimbabwe. And what was of great help in Zimbabwe was naturally when the US dollar became an accepted currency there.